Welcome to the White Collar Files, the podcast that delves deep into the fascinating world of financial crime and corporate misconduct. I'm your host, Ethan, and in today's episode, we're exploring the landmark legislation and regulatory changes that have shaped the landscape of white-collar crime enforcement. Buckle up for a riveting journey through history that will change the way you think about corporate accountability. Let's dive in. Today, we're taking a deep dive into the evolution of white-collar crime legislation and regulation in the United States. This is a story of scandal, reform, and the ongoing battle to keep corporate America honest. Let's start with the Securities Act of 1933 and the Securities Exchange Act of 1934. These two pieces of legislation were born out of the ashes of the 1929 stock market crash and the Great Depression. Before these acts, the stock market was essentially the Wild West. Rampant speculation, insider trading, and market manipulation were par for the course. The Securities Act of 1933, often referred to as the Truth in Securities Law, had two main objectives: to ensure more transparency in financial statements so investors could make informed decisions about investments, and to establish laws against misrepresentation and fraudulent activities in the securities markets. It essentially mandated that investors receive significant information about securities being offered for public sale, and prohibited deceit, misrepresentations, and other fraud in the sale of securities. The following year, the Securities Exchange Act of 1934 created the Securities and Exchange Commission, SEC. This was a game changer. For the first time, there was a powerful federal agency whose primary mission was to enforce newly written securities laws, propose securities rules, and regulate the securities industry, the nation's stock and options exchanges, and other electronic securities markets. These acts laid the foundation for modern securities regulation and white-collar crime enforcement. They established the principle that transparency and accurate information are crucial to the integrity of the markets. Moving forward a few decades, we come to the Foreign Corrupt Practices Act, FCPA, of 1977. This legislation was a direct response to a series of foreign bribery scandals that came to light in the mid-1970s. The most notable of these was the Lockheed bribery scandal, where the aerospace company admitted to paying millions in bribes to foreign officials to secure contracts. The FCPA was groundbreaking in two main ways. First, it made it illegal for U.S. companies to bribe foreign officials to obtain or retain business. This was a bold move that effectively extended U.S. law enforcement beyond its borders. Second, it required companies to maintain accurate books and records and to develop a system of internal controls. This second provision was crucial because it made it much harder for companies to disguise bribes as legitimate business expenses. The FCPA marked a significant shift in how the U.S. approached international business practices. It set a global standard for anti-corruption efforts and has been a model for similar legislation in other countries. Now, let's fast forward to the turn of the millennium and the Sarbanes-Oxley Act of 2002. This legislation was enacted in response to a wave of corporate and accounting scandals, including those affecting Enron, Tyco International, and WorldCom. These scandals cost investors billions of dollars and shook public confidence in the nation's securities markets. Sarbanes-Oxley, often abbreviated as SOX, introduced sweeping changes to financial practice and corporate governance regulation. It established the Public Company Accounting Oversight Board, PKOB, to oversee the audits of public companies. It also mandated that senior executives take individual responsibility for the accuracy and completeness of corporate financial reports. One of the most significant provisions of SOX is Section 404, which requires management and the external auditor to report on the adequacy of the company's internal control over financial reporting. This was a direct response to the off-balance sheet entities that Enron used to hide its true financial condition. SOX also increased the penalties for corporate and criminal fraud. It created new standards for corporate accountability and penalties for misbehavior. The act made it a crime to destroy, alter, or falsify financial records, and it increased the maximum jail terms for mail and wire fraud. The impact of Sarbanes-Oxley has been profound. It significantly raised the stakes for fraudulent financial activity and forced companies to take internal controls and financial reporting much more seriously. While it has been criticized for increasing the regulatory burden on companies, particularly smaller ones, it's generally seen as having improved corporate governance and financial transparency. Next on our journey through landmark legislation, we come to the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. This massive piece of legislation was a direct response to the 2008 financial crisis, which was the most severe financial crisis since the Great Depression. Dodd-Frank brought the most significant changes to financial regulation in the United States since the regulatory reform that followed the Great Depression. It made changes affecting all federal financial regulatory agencies and almost every part of the nation's financial services industry. One of the key provisions of Dodd-Frank was the creation of the Consumer Financial Protection Bureau, CFPB. This new agency was given broad powers to write and enforce regulations covering consumer financial products and services. Dodd-Frank also introduced the Volcker Rule, which prohibits banks from conducting certain investment activities with their own accounts and limits their dealings with hedge funds and private equity funds. This was an attempt to prevent banks from making speculative investments that don't benefit their customers. In terms of white-collar crime enforcement, Dodd-Frank significantly enhanced the SEC's enforcement capabilities. It expanded the SEC's authority to bring actions against control persons, typically high-level executives, in cases of securities law violations by their companies. It also authorized the SEC to pay whistleblowers for information leading to successful enforcement actions. The act also created new criminal offenses. For instance, it made it a federal crime to receive compensation for providing false credit ratings on structured financial products. This was a direct response to the role that inflated credit ratings played in the financial crisis. Now, let's talk about a piece of legislation that's had a significant impact on international white-collar crime enforcement, the UK Bribery Act of 2010. While this isn't U.S. legislation, its global reach has affected many U.S. companies doing business abroad. The UK Bribery Act is often described as the toughest anti-corruption legislation in the world. It goes even further than the U.S. Foreign Corrupt Practices Act in several ways. For instance, it prohibits not just the bribery of foreign public officials, but also private-to-private bribery. It also doesn't make any exceptions for facilitation payments, small bribes paid to facilitate routine government action, which are permitted under certain circumstances by the FCPA. Perhaps most significantly, the Act introduced a new strict liability offense of failing to prevent bribery. This means that a company can be held criminally liable if someone associated with it bribes another person intending to obtain or retain business for the company. The only defense is for the company to prove that it had adequate procedures in place to prevent bribery. This has had a profound effect on corporate compliance programs. Many companies have had to significantly enhance their anti-bribery procedures to ensure they have a defense under the Act. The impact has been felt well beyond the UK, as the Act applies to any company that carries on a business, or part of a business, in the UK. Moving back to the U.S., let's discuss a recent and significant development in anti-money laundering legislation, the Anti-Money Laundering Act of 2020, AMLA. This act, passed as part of the National Defense Authorization Act for fiscal year 2021, represents the most comprehensive set of reforms to the anti-money laundering regime in the U.S. since the USA Patriot Act of 2001. One of the most significant provisions of the AMLA is the creation of a beneficial ownership registry. This requires certain corporations and limited liability companies to report information about their beneficial owners to the Financial Crimes Enforcement Network, FinCEN. This is aimed at cracking down on the use of shell companies to hide illicit funds. The AMLA also expands the ability of financial institutions to share suspicious activity reports, SARs, with their foreign branches and affiliates. This is intended to improve the global fight against money laundering and terrorist financing. Another key provision of the AMLA is the expansion of the Bank Secrecy Act's definition of financial institution to include businesses that deal in virtual currencies. This brings the rapidly growing cryptocurrency sector more firmly under anti-money laundering regulations. The Act also significantly enhances whistleblower protections and incentives. It increases the maximum award for whistleblowers from $150,000 to up to 30% of the monetary sanctions collected in certain enforcement actions. This is expected to lead to an increase in whistleblower reports of potential violations. Now, let's talk about a piece of legislation that's currently making waves in the corporate world, the Corporate Transparency Act, CTA. Enacted in 2021 as part of the National Defense Authorization Act, the CTA aims to combat the use of shell companies for illicit purposes, including money laundering, terrorist financing, and other financial crimes. The CTA requires certain businesses to report information about their beneficial owners to FinCEN. A beneficial owner is defined as an individual who either exercises substantial control over the company or owns or controls at least 25% of the company's ownership interests. This reporting requirement applies to corporations, limited liability companies, and similar entities, with some exceptions. For instance, companies with more than 20 full-time employees and $5 million in gross receipts or sales are exempt, as are certain regulated entities like banks and public companies. The information that must be reported includes the beneficial owner's full legal name, date of birth, current residential or business street address, and a unique identifying number from an acceptable identification document. This information will be stored in a database accessible to law enforcement agencies and financial institutions, with customer consent. The CTA represents a significant shift in corporate transparency requirements in the U.S. It's expected to help law enforcement agencies track illicit funds and combat financial crimes more effectively. However, it also places a new compliance burden on many small businesses. Let's now turn our attention to a piece of legislation that's had a significant impact on corporate compliance and internal investigations, the Yates Memo of 2015. While not technically legislation, this Department of Justice, DOJ, policy memorandum, named after its author, then Deputy Attorney General Sally Yates, has had a profound effect on how corporations approach white-collar crime investigations. The Yates Memo emphasized individual accountability for corporate wrongdoing. It stated that to be eligible for any cooperation credit, corporations must provide to the DOJ all relevant facts about the individuals involved in corporate misconduct. This was a significant shift from previous policy, which allowed corporations to receive partial credit for cooperation even if they didn't fully disclose individual wrongdoing. The memo also instructed DOJ attorneys to focus on individuals from the inception of a corporate investigation. It emphasized that corporate resolutions should not protect individuals from criminal or civil liability, except in extraordinary circumstances. This policy has had several significant effects. It's led to more thorough internal investigations by corporations, as they seek to uncover and report individual misconduct to receive cooperation credit. It's also led to increased tension between corporations and their employees during investigations, as employees become more wary of cooperating with internal investigations that could lead to their personal liability. While the Yates Memo has been modified somewhat in subsequent years, its core principle of individual accountability remains a key focus of DOJ corporate enforcement policy. Now, let's discuss a recent development that's shaking up the world of corporate compliance, the DOJ's Monaco Memo of 2022. Named after Deputy Attorney General Lisa Monaco, this memo builds on the principles of the Yates Memo and introduces several new factors for prosecutors to consider when evaluating corporate compliance programs. One of the key aspects of the Monaco Memo is its emphasis on corporate culture. It instructs prosecutors to consider whether a company's compensation systems reward compliance and impose financial sanctions on employees who engage in misconduct. This represents a shift towards viewing compliance not just as a set of policies and procedures, but as an integral part of corporate culture. The memo also emphasizes the importance of personal devices and third-party applications in corporate investigations. It instructs prosecutors to consider whether companies have policies and procedures governing the use of personal devices and third-party messaging platforms for business communications. This reflects the DOJ's increasing focus on these often overlooked sources of evidence in corporate investigations. Another significant aspect of the Monaco Memo is its guidance on corporate recidivism. It instructs prosecutors to consider a company's full criminal, civil, and regulatory record when making decisions about resolutions. This means that companies with a history of misconduct may face more severe consequences, even if the past misconduct was in a different area or jurisdiction. The memo also provides new guidance on the use of independent compliance monitors. It removes the previous presumption against requiring monitors and instructs prosecutors to consider a range of factors when deciding whether a monitor is appropriate. These policy changes are likely to have a significant impact on corporate compliance programs and how companies approach internal investigations and interactions with the DOJ. Lastly, let's touch on a piece of legislation that's currently in the works and could have a significant impact on white-collar crime enforcement, the Enablers Act. This proposed legislation, which has bipartisan support in Congress, aims to close loopholes in U.S. anti-money laundering laws. The Enablers Act would expand the definition of financial institution under the Bank Secrecy Act to include professional services providers who serve as gatekeepers to the U.S. financial system. This would include lawyers, accountants, real estate professionals, trust and company service providers, public relations firms, art dealers, and others. If passed, the act would require these professionals to establish anti-money laundering programs, including customer due diligence procedures, and to report suspicious transactions to the government. This would be a significant expansion of anti-money laundering obligations beyond traditional financial institutions. The proposed legislation is partly a response to the Pandora Papers investigation, which revealed how professional service providers help the wealthy and powerful conceal their assets. It's also part of a broader global trend towards increasing regulation of these gatekeepers to prevent money laundering and other financial crimes. While the Enablers Act is still just a proposal, it represents a potential significant shift in U.S. anti-money laundering policy. It's part of a broader trend towards expanding the scope of anti-money laundering obligations and increasing corporate transparency. As we've seen, the landscape of white-collar crime legislation and regulation is constantly evolving. From the foundational Securities Acts of the 1930s to the recent Corporate Transparency Act and proposed Enablers Act, lawmakers and regulators are continually working to keep pace with new forms of financial crime and corporate misconduct. These legislative and regulatory changes reflect broader shifts in how we think about corporate accountability, transparency, and the role of gatekeepers in preventing financial crime. They also demonstrate the ongoing challenge of balancing effective law enforcement with the need to maintain a business-friendly environment. As we move forward, it's likely that we'll continue to see new legislation and regulatory changes in response to emerging threats and evolving business practices. The rise of cryptocurrencies and other digital assets, for instance, is already prompting new regulatory approaches. Moreover, we're likely to see continued emphasis on individual accountability and corporate wrongdoing, as well as increased focus on corporate culture and compliance programs. The trend towards greater corporate transparency is also likely to continue, potentially with new reporting requirements and public registries. For businesses, staying compliant in this evolving landscape can be challenging. It requires not just keeping up with new laws and regulations, but also fostering a culture of compliance and ethical behavior throughout the organization. For law enforcement and regulators, the challenge is to use these new tools effectively to prevent and prosecute white-collar crime, while also adapting to new technologies and business models that may be used to facilitate financial crimes. As we've explored in this episode, the history of white-collar crime legislation is a story of reaction and adaptation, reacting to new scandals and adapting to new forms of misconduct. It's a never-ending process, but one that's crucial for maintaining the integrity of our financial systems and corporate sector. That brings us to the end of today's episode of the White Collar Files. I hope you found this journey through the landmark legislation and regulatory changes in white-collar crime as fascinating as I have. If you enjoyed this episode, please don't forget to subscribe to our channel and give us a like. Your support helps us continue to bring you in-depth explorations of the world of white-collar crime. Until next time, this is Ethan signing off. Stay vigilant and stay informed.